From Kansas State University, this is Agriculture Today. Eric Atkinson with you, and here's what's ahead. K-State's Dan O'Brien will go over the lead market indicators from this week's USDA World Grain Supply and Demand Report. As the grain markets continue to feed on generally bullish factors, he'll also go over the latest grain basis bids at local Kansas elevators. Those remain strong as well. And K-State's Gregg Ibendahl is back to share that just-posted fertilizer price outlook he talked about earlier this week, using current trends in corn and oil prices as the foundation for his analysis. He thinks that the price of fertilizer might level off midway through the year. And K-State's Chip Redmond stands by to talk Kansas agricultural weather. All that right here on Agriculture Today. This is the K-State Radio Network, and you're tuned to Agriculture Today. On this Friday edition, we get things rolling with the grain market overview, and in studio with us today is Dan O'Brien, grain market economist with K-State Research and Extension. Dan, we've several things to pour over here today, but we might as well start with the logical one, and that would be the USDA's World Agricultural Supply and Demand Estimates Report, or Grain Supply and Demand if you prefer, which was released on Wednesday. Fairly minimal news there. There was a tidbit there of interest to the wheat trade, but what is your take on that?
Really, the USDA stood back and decided to make no changes at this time in the feed grains, so really no changes at all for corn, for grain sorghum. It's almost as if they're waiting for the next quarterly stocks report that will be released at the end of March to come in and make substantive changes. However, there also is, here coming up, I think it's the 23rd, 24th, 25th of this month, they'll have the USDA Outlook Conference. And at that, then we'll start to see USDA's thoughts in terms of acres and where they think prices may go in the coming years. So it's almost as if, again, they've just sort of thought they would keep their powder dry until they got to that on the feed grains. They made a little bit of a change in terms of their expectations on wheat supply demand, in that they lowered their export number. And I think that had affected also on the hard red winter wheat. They cut back that by about 10 million bushels, and then other assorted changes around. So with that, really no major change in terms of ending stocks, just a small 20 million bushel adjustment 2025. And really not much of a challenge there in terms of issues. They did raise the U.S. price by about 15 cents from the January report. So nothing there that was a real change in paradigm or change in thought. And on the soybeans, they did increase the crush, and that's consistent with strength that we've seen in the soy complex of late. And again, with that, no major changes otherwise. I think, frankly, the market's paying more attention to issues that would have to do with, again, geopolitical conflicts. Now, that could affect things on the one hand, or primarily what's going on down South America.
That's day to day as well, what develops with their weather patterns and the dryness that has persisted in that part of the world. And that hasn't changed, that story. There's still concern about their productivity.
Some market analysts that you and I both know, independent analysts that have come out and stated that some of the internal numbers coming out of Brazil right now, out of some of their producer associations, are, quote, game changers. Even though there's some moisture coming into those areas, it seems that their own internal cutbacks and what the USDA had already shown as a cutback, and with these other cuts coming from inside Brazil, inside these South American countries, making even more cuts, it brings you to the point of wondering about the export potential coming out of South America for crops. Again, they've had price strength there, given how tight things are. And there's the likelihood of more export business in the world being pushed to the United States. And of course, China being such a dominant player there, there's potential for China to purchase even more from the U.S. And you can see it in the prices. When you look at soybean futures, we've had a strong run from the 14.45 level up to, closed 15.74, had gotten up over $16 to 16.25 or so. If you're a technical signal watcher and watch the relative strength in indices, knowing that anything over 50 is positive. Well, we're above 70. That's 74%. 74 as an indice rating, which is a strong bull market signal. And really, you wonder how long can something that's been running up so strong continue, and what else would need to come along to continue that strength. Markets may tend to run up high as they take in new information and then sit there and wait for anything else to come along. So we'll see what happens. But the production side, with the short crop in South America, for soybeans, it certainly affected things. And you've also got the corn market behaving almost as strong. Had been trading about 641 3/4, again about 640 or so, had run up to about 665, 670, have come back down. What I wonder about now is how the strength in the corn market for D's 2022 corn relative to the strength in the soybean market for November 2022 corn, how that works itself out in terms of incentives for planting here in the United States. And the last time I calculated those numbers, it was a clear advantage for new crop soybean to corn price ratio to soybeans. We were about 2.4, heading for 2.5, and 2.3 is a neutral number that we tend to go at.
It ought to be an intriguing battle for acres. Maybe a stem winder in that respect here, Dad.
Well, it makes you wonder about strength in coming months in that new crop D's corn contract as an incentive, particularly coming from all the strong usage industries we have in the United States that don't want to, quote, be left behind.
All of this is being reflected now in our local grain basis bids around Kansas, and we've talked about the strength there in recent weeks. That hasn't abated at all, has it?
When you look at corn basis at the key locations we've been following, and again, picking the highest bid at each location, just want to put that out front. In Colby, we're 20 over for the cash price yesterday, 15 over in Salina, Topeka at 5 over, Garden City at 44 over for cash prices, Hutchinson at 34 over. Southeast Kansas is 5 under, but that's still a pretty strong basis. So you have that. Pretty similar. In fact, for grain sorghum, and by the way, we've had a pretty good week of grain sorghum exports just this last week or so. And you've got Colby at 25 over, Salina at 60 over, Topeka 54 over, 14 over at Garden, and Hutchinson at 29 over, and again, it's the same 5 under in Southeast. So really strong feed grains, and again, that's what you've got there is indicative of with the strong grain sorghum basis, we're moving some grain now and through export channels. Soybean basis really pretty strong. You know, when you have anything approaching a positive basis in the vicinity of it for soybeans in Kansas, that's a pretty good thing. Strongest basis bids at Topeka at 25 under, at Salina at 36 under, Hutchinson 26 under, and again, not coincidentally, those are the main export locations in the state. Even southeast Kansas at Columbus at 41 under, and that's a pretty strong basis historically. Wheat bids at our strongest bid terminals in Salina, Topeka, Hutchinson are even with the futures. There's not even a hint of a negative basis there. And at Garden City, not necessarily known as a major export area for wheat, 7 under. You do have 25 under basis at Colby and 45 under at Columbus. And then, of course, we try to look at cash basis bids and also the new crop bids. And what does stand out is at Garden City for corn that they have a 20 over new crop bid. Of course, they're right in the middle of a demand center right now, right there with all the feedlots. Even money at Salina for grain sorghum for a new crop bid. The strongest new crop bid on soybeans, well, it would be at Salina at 55 under. Again, pretty strong basis bid this far out. Topeka at 60 under, just right behind it. And for wheat, again, we're just around the corner with people wondering about what type of prices they might want to lock in for new crop wheat this year. Based off the July contract, you're looking at the best basis bids at Topeka, again, 21 under, and just a number of them at 30 to 31 to 36 under, one at 40 under. So really pretty strong new crop bids. We'll see in drier areas just how anxious people are to stand in and do forward contracting or hedging at these levels, given some of the uncertainty they have with crop production on the wheat side.
Well, to finish up here, want to step back and take a wider view of the general economy and some information that came out earlier this week about inflation trends and the fact that inflation is expected to continue to build in our economy, and that causes a ripple through everything, and the grain markets are no exception there, Dan.
Yes. The big issue that agriculture has been affected by in the past has been interest rates. That was what precipitated a lot of the farm crisis back in the 80s, as we had inflation affecting the overall U.S. economy. And at that time, there had been a whole string of about a decade of pretty strong inflation coming in. So with, if not historic highs, really, really strong inflation, 7+ % projected yesterday by the U.S. government, then there's the question of what might the Federal Reserve do in terms of interest rates. When you look at the CRB index, which is kind of an amalgamation of energy and ag stocks as commodities against the Commodity Research Board CRB index, that has been running up actually stronger than the overall stock market as a trend of late. So there would be some concern that as interest rates are raised, then do we see money come out of, to some degree, some cash come out of the financial markets and have that cash exodus to safer investments also come in and have a crossover effect onto commodities. So here what we're talking about is that perhaps as large a threat to ag markets as weather, rain, or lack thereof that could affect them off into the future would be the likelihood of governmental regulatory actions that could affect the financial markets that would bleed over and have an impact on the grain markets.
No lack for talking points in these markets. Dan keeps up on all of it via his weekly notes on the grain trades. The latest edition posted now on agmanager.info. Dan, good to have you by. We'll talk again next week.
Thanks, Eric. Take care.
Grain market economist Dan O'Brien of K-State Research and Extension. Agriculture Today continues in a moment on the K-State Radio Network. We're back now on this Agriculture Today. And our guest across the way now has boldly gone where few have dared to go of late, and that is putting forth a forecast on crop fertilizer prices. Joining us once more, Gregg Ibendahl, farm management economist, K-State Research and Extension. Last time you were here visiting with us a few days back, Gregg, you promised that you were going to have some considerations on fertilizer prices looking forward, and here it is. This is not the first time that you've made a foray into this, though.
No, I've kind of been dabbling in the fertilizer prediction market for probably about a decade or more now. And, I first started out doing models based on natural gas, which is really, when you think about it, you would think natural gas would be the obvious thing to look at because we have to use natural gas in a combination with nitrogen in the air, and then we produce anhydrous that way. So you would think natural gas would work really good as a predictor. Well, it turns out, and I never could get a very good model to fit because I think there's a lot more variability in the natural gas prices than there is in the fertilizer market. So I started playing around, and I got to thinking, well, oil is a close substitute for natural gas in a lot of situations because they're both used for energy and heat and that kind of thing. So let's try oil in the model. And when I did that, it was almost like a revelation. The model suddenly started working a lot better. So I kind of used oil then on the supply side of the model. Then I used corn demand, which seemed to track pretty well with the anhydrous price, and combined those two together. And I actually started getting models that actually work pretty well for predicting the anhydrous price.
That was last year in 2021 when fertilizer prices were not nearly as robust. Well, times have changed since, as all know, and you were wanting to answer some questions about where we're at, whether in fact these high fertilizer prices are likely to have a shelf life, to put it that way.
Yeah, so last year when I did this, I ran the model, and I got like a 0.85 correlation, which is really, really good. And even last spring, I was predicting fertilizer prices were going to go up. Now, obviously, I well underestimated how much they were going to go up, but I did forecast a price increase. But, my model was working really good until about summertime, and then all of a sudden fertilizer prices just started, going up astronomically high, and obviously, so my model didn't work too well now. So what I'm trying to do now is basically figure out what happened, and I actually this time incorporated another factor into the mix. I think helps somewhat, although I'm still pretty far off really for where we are now. But I think I'm on the right track anyway.
And you'll keep going and looking at this repeatedly as we go along. But how you worked through this, what data are you leaning on as far as prices out there?
Well, so, we got national corn prices. I can look at the futures market to get an idea from that. And as I mentioned in my oil and gas talk, we have plenty of ideas about where oil is going to go, looking at what the Energy Information Association is predicting. So I have that. And then I decided, well, part of the reason why I think things may be higher now is I think there's probably some inflation built into everything. Certainly inflation really ramped up this last fall, so I decided to incorporate inflation expectation into my model as well. The Federal Reserve keeps track of this survey from the University of Michigan where they actually asked people about inflation expectations. And that seemed, just visually looking at it, seemed like it might match up pretty well, too, with the anhydrous price. So I actually added a third factor to my model this year. So besides corn and oil, now I have incorporated inflation expectations.
There is an aspect of this that is well worth mentioning as we talk about your approach to this analysis. That is that anhydrous prices, anhydrous ammonia, tend to lag some behind oil prices?
Well, actually, so we can look at what happened in the oil market about 6 months ago, and that's actually a pretty good idea for what happens with the anhydrous price right now, because obviously, producers, it's going to take them a while to incorporate. They do see a change of oil and how much anhydrous they're making. So there really is probably at least I think in the past I've used a 9-month lag looking at oil prices. This time I found a 6-month lag worked almost just as well. So in the current model, I'm basically lagging oil prices by 6 months and including that as my predictor variable.
So you threw all of this together into your model, which has performed quite well, like you say, up until recent volatility in the fertilizer market. And you've tried to come out with some semblance of an idea of where fertilizer prices may be trending in the months ahead? What?
Well, possibly. So I incorporated those three factors together and ran the model. And if you go back and look at the historical data that I showed on one of the graphs, I can track from, I think whenever I started with this, about 2009, all the way until last summer. It tracks really, really close. And suddenly we get to summertime and anhydrous prices just shoot through the roof. And then it kind of breaks. So I got several factors going on there, even though I have incorporated inflation in there now. I really don't have enough data points to fit that model very well. And part of the issue, too, I think, is we got to ask ourselves, how permanent is this increase in fertilizer prices? So, is this just a temporary bump up? And there's some historical precedents for that's actually happened in the past. You go back and look at way in the past, like I think about 2008, there was about a 3-month window where fertilizer went to prices even higher than what they are now. They went up really quick and they came down really quick. So we really have two things, I think, that could explain this model, maybe why it's not working. One, maybe there is another factor out there that I really need to include. And with COVID and everything, who knows what that might be. But again, the second option could be, well, maybe this is just a temporary 3 or 4 month spike and things will come back down and maybe come summertime.
That's more or less your guesstimate, as you state in your article, that we may see this decline come on, although it may not be at the same pace as the rise in fertilizer prices.
Yeah, again, my guesstimate about this whole thing is I think there's enough uncertainty floating around with COVID and supply chain issues and some things like that, I really think fertilizer prices are higher than what they should be, but all that uncertainty certainly lends itself to an increase in fertilizer prices, too. So I think things will come down. I think it's going to be slower. If you're a producer, though, looking to buy fertilizer, I'm not sure that's really going to do you any good because I don't really see things coming down really substantially until probably after spring planting season is done. So that's kind of a negative for the producer side. It may help you come, wheat sowing time, but right now I think you may be stuck a bit.
Maybe the more realistic question, when will fertilizer prices level off anyway from the incline we've seen?
Well, just based on my model, looking at what I have going into that, oil prices, again, the EIA is predicting $75 a barrel. I'm looking at what the corn future market shows and what I originally had in there for inflation. I kind of look at things at least maybe leveling off, maybe like March or so, and then maybe a kind of a gradual decline. So that makes me hopeful that at least fertilizer prices won't go much higher than the $1,500 we're seeing nationally for anhydrous, that things will level off at least and maybe not get much higher than that, and then maybe start to come down at least slowly. That'd be the worst case scenario. Best case, they come down a lot more. But we have things like there's been a fertilizer plant fire in North Carolina is one thing to worry about. And then we just got, today we got new reports on inflation, which are much higher than what I had first anticipated. I think the last month I had maybe like a 5% inflation. I just saw they have said we had 7.5% the last model that they had. So again, maybe it should be higher than what I'm predicting.
You may be tweaking this further and posting it on agmanager.info. We'll keep watching. But one more wild card worth mentioning here, geopolitical developments and what's happening in the Russia-Ukraine situation could have direct relevance on fertilizer prices.
Yeah, I think it is for sure. When I looked at the EIA forecast of $75 a barrel, I was kind of shocked that they had things that low. I'm not sure what they were basing that on. I'm assuming that they didn't have any kind of world influence issues going on there either. But a lot of oil and gas comes out of Russia, so I think any kind of conflict like that is going to be bad for not only fuel prices, but it's certainly going to affect the fertilizer market as well. In fact, if you go back and look at that situation back in 2008 where fertilizer prices did peak up higher than what they are now, there was a corresponding rise in the oil price at that same time. So I think at that point, if I had enough fertilizer data to go back and look at that, I probably could have predicted that spike based on what oil prices were back then. But we don't have that current spike in oil prices like that as we're seeing now. So assuming that if the EIA forecast is wrong and we do get into something with Russia and Ukraine and that kind of things affect oil market, if oil prices would just jump way up, that's going to affect fertilizer prices sooner or later.
Nothing happens in a vacuum here.
Oh,
that's
certainly not.
Sure. Then as a farm management economist, what you're saying to producers, just plan on where we're at as far as their fertilizer costs, and with the notation that there still may be a profit to be had given where grain prices are?
Yeah, I think so. You starting to see some moderation in the fertilizer markets already, so I think that might be an indication maybe we are starting to top off a little bit. But I can't see a very substantial decline before spring planting season. So I think sooner or later producers are probably going to have to bite the bullet. And with some of those reports we see of maybe fertilizer being in short supply, you may want to lock up what you can if you can get the kind of stuff you're looking for. Maybe whether you use some kind of dry product or anhydrous or one of the liquid fertilizers, you may just have to take what you can get at the best thing you can use, and then just hopefully we'll have lower prices come planting time. So that's my best recommendation is, and if you look at our crop budgets, they still show a profit, even though it is a lot, certainly less than what it was going to be before, but there's still profit to be made in corn and soybeans. Yeah.
Efficiencies agronomically will carry the day for a lot of producers here in as far as making the most out of what they do have to purchase in their fertilizer.
Oh, yeah. Look at our budgets and, make proper decisions between corn, soybeans, and wheat and grain sorghum and go forth, I guess.
In the meantime, you'll be keeping an eye on this and providing further information as dynamics change, Greg?
Oh, yeah, there's certainly enough interest in this topic and enough volatility going around that I think I'm going to keep a close hand on trying to predict the fertilizer prices throughout this next year.
Well, that's appreciated, as is the information like this article on your latest analysis. It is right there for the reading now at agmanager.info. Greg, good work as always. Thank you for coming by.
Thank you.
Farm management economist with K-State Research and Extension. That's Gregg Ibendahl with us. And we'll return with the latest on Kansas agricultural weather after this break. This is the K-State Radio Network. For you now on Agriculture Today, our weekly stint on Kansas agricultural weather and the observations of K-State Research and Extension meteorologist Chip Redmond. Well, Chip, it was a fairly dry week as the calendar reads. Now, the drought monitor goes back into last week, but our general status has not improved greatly at all. That's the point.
Yeah, we saw widespread expansion this week of moderate drought to basically encompass all of north central Kansas. That area has missed out on precipitation basically since the beginning of the year. And with the warmer conditions that we've seen over the last 2 weeks and with the breezy conditions, so moderate drought got expanded there. And then we did actually see some improvement in the southeast, where they dropped the moderate drought, where they got about an inch of moisture in far southeast Kansas, both with rain and snow for that area last week.
But are other parched areas remain so? Western Kansas still very much mired in a drought?
Yes, very much so. They did get moisture out there last week, especially far southwest Kansas and Elkhart area recorded about 9 inches of snow. But the liquid equivalent of that snow was very little, about a quarter inch or so at best. So enough to be a little bit over the weekly average, but didn't help with the long-term deficits out there.
You mentioned this just a second ago, windy conditions again for this past week, Chip. These wind gradients just seem to be incessant, almost day by day, and not just light breezes either most days. Why is that so regular anymore?
Well, it's because it's part La Nina. We have a very typical La Nina pattern in place with basically northwest flow. So all the storm systems in the central U.S. moving from the northwest towards the southeast and east. And what that does, it puts us in the battleground between the low pressure to our north and east and the high pressure to our south and west. And so that puts a big, tight pressure gradient over us. And it's an active pattern, so we're getting cold frontal passages about every day or every other day. And that's bringing an additional push of northerly winds about every other day. And then the warmer air retreats back northward, we get the breezy southerly winds. So it's typical for the active pattern that we have right now. It's just unfortunately a very dry pattern for us, so we don't get moisture with those winds.
Well, Chip, looking ahead this weekend, after we've enjoyed a relatively mild week weather-wise around Kansas, a cool down is expected. What's the word on that?
Well, we have a little bit more of a potent cold front that's going to arrive on Friday. That's going to bring a little bit cooler air mass for Saturday. We'll see, high temperatures in around 30 degrees or so, breezy, of course, and it'll be short-lived. We'll have that warm air push back northward very quickly on Sunday. We'll see breezy southerly winds into early next week. That'll set the table for the next storm system on the horizon, and that is expected to arrive somewhere around midweek next week. And the track is still being determined. There's a lot of elements at play. Basically, when a pattern that's been persistent like this breaks down, the predictability is very low. But the good news is right now there is moderate confidence at precipitation, most likely in the eastern side of the state, but precipitation somewhere in the central plains.
To the extent of more than just a drizzle, will we see some at least reasonably decent amounts, perhaps?
Yeah, that's a great question. If this kind of system impacted the state, say, in May, we'd be looking at likely severe thunderstorms and widespread rains. But the timing is just too early, and so it doesn't really have the good trajectory for a good widespread heavy precipitation. It won't be a drought buster by any means. We're definitely due to at least try to catch up on the deficits we've developed over the last 2 weeks.
Well, we'll track it as it goes along, Chip. Enjoy your weekend. Thank you for being along with us once more. Appreciate it.
Thank you very much.
K-State Research and Extension meteorologist Chip Redmond. He's along with us weekly with his input on Kansas agricultural weather. Our time's away once more. Our thanks to you for listening in, and do enjoy your weekend. Eric Atkinson for Agriculture Today over the K-State Radio Network.